Hi, Elijah. This is quite a hectic partnership question, but what I'm going to do is I'm going to work through the income statement of the partnership first as a separate video to the balance sheet. So let's get going. If I record a video, then you're able to watch this in your own time and you're able to watch it many times. So let's have a look here. These two partners are in partnership, sharing the profits and losses 3:2 respectively. The following balances were extracted from the partnership books, and this is your year end at the 31st of December 2019. So they've given you all these balances at the end of the year, plus there are also balances at the beginning of the year. Now this partnership, they are using a periodic inventory system because they're using an account purchases to record the stock that they've bought during the financial year, which means they calculate their cost of sales at the end of the year when you use a periodic inventory system. I think I asked you to watch a video on perpetual and periodic, so you should know the differences. So these are the numbers that they give us on the 31st of December 2019. Purchase of stock, sales, carriage inwards. This amount here is used in the calculation of cost of sales. You can see I've made a few notes here because we're going to have to do the income statement and we're going to have to calculate the cost of sales. The salaries and wages for the year was 12,900, and you'll see that one of the partners' salaries was included in this amount, and it needs to be taken out and shown separately in the current account, but that's more for the balance sheet. We're going to do the income statement first. Then there were general expenses. There is an adjustment with regard to the general expenses, and there's also an adjustment with regard to rent and rates. Those adjustments, there's more information in the additional information. Then there were the capital accounts, what the owners put into the business, and then there were current accounts and drawings. These three different accounts make up owner's equity, but we're doing the income statement, so we're concerned with income and expense accounts. So purchases will go in the income statement, sales will go in the income statement, carriage inwards would be used to calculate cost of sales, salaries and wages, expense, rent and rates, expenses. So we're looking for the income and expense accounts. These here, we call them balance sheet accounts, B accounts. Now discount allowed is when a debtor whom we've sold to on credit is given, say for example, a discount for paying us early. It is discount allowed, and discount allowed is treated as an expense, so it will go into the income statement. Discount received is when we pay a supplier from whom we've bought on credit, let's say for example early, prompt settlement, and we get a discount. That is income to us. Then there's returns inwards, and what I know that as is sales returns. So for example, I sold to a debtor on credit and they returned goods to us because they were not happy. That's called sales returns. And the returns inwards, that's what you guys call it, or what this question calls it, needs to be taken off the sales amount. Then there's returns outwards, and what that means is we bought stock during the year and we returned the items. Excuse me for one moment. Sorry, I had to sneeze. Right, returns outwards is when we make purchases and we weren't happy with the items or the stock that we purchased, we need to return it. And this amount, this 200, needs to be taken off, you'll see, the purchases amount. Okay, then we got motor vehicles at cost. We're going to use that number to calculate depreciation. Furniture and fittings at cost. We're going to also use that to depreciate. Now there's some balances that they give us at the start of the year. Motor vehicles is the provision for depreciation. We call it accumulated depreciation at the start of the year. Furniture and fittings also had a balance at the start of the year, accumulated depreciation. I've just put the plus 6,000 and plus 12,000 because we're going to calculate depreciation for the current year. Then at the start of the year they give us the stock balance, which is the opening stock. We're going to use that in the calculation of cost of sales. Then debtors, 6,600, we're going to use that to calculate the provision for bad debts on debtors, and we will see there's a balance there for creditors as well, and a balance for provision for bad debts. What that means is we always know that there are going to be debtors who don't pay us, bad debts, and we need to do an adjustment to truly reflect what the asset value is for debtors, and we do that by making a provision for bad debts. This is the provision for bad debts balance at the start of the year. You will see one of the adjustments in a moment will be to adjust this balance to 300. At the moment it is at 400. Then they give us a balance for bank overdraft and a petty cash balance at the start of the year. We will have a look at that in the balance sheet. So it's quite important to familiarize yourselves with the accounts. Are they income accounts, expense accounts, partnership owners accounts, liabilities, right? You need to be able to categorize these. What we're going to do is we're looking for income and expense accounts, because the first thing we're going to do is the income statement. So we're given this information, additional information. We got closing stock. Closing stock is used in calculating cost of sales in this periodic inventory system. We got rates paid in advance, which amounted to 300 Rand, which means we've actually paid too much with regard to the rates account. The rates account is here. Right, but anyway, we've paid 300 Rand too much with regard to the rent and rates. That amount there is actually too much because we've paid 300 Rand, which is only due for our next financial year. So rates paid in advance amount to 300 Rand. You're going to have to make an adjustment there. I keep saying rands, I apologize. It should be kwacha. There's 200. It was owed for general expenses on the 31st of December. So our general expenses account is too small. There should be another 200 Rand. I'm saying it again, Rand. So it's kwacha, Elijah. Kwacha. So 200 Rand needs to be added to the general expenses. And then we got fixed assets that need to be depreciated using the straight line method. And they tell us motor vehicles at 20% and furniture and fittings at 10%. Then we need to, I mentioned earlier, make a provision for bad debts to adjust the amount that is in our books at 400. It needs to be adjusted to 300. There I've made some notes, but I'll come back to them. Okay, then these number 6, 7 and 8 relate to the partners, and that will go into the balance sheet, right? But for now, this lesson, I'm doing the partnership income statement. So let's have a look at the income statement. I found the memo, I took it off the internet, so I just took a screenshot, and let's get going. So the sales amount is quite easy, 80,000. I took the sales amount off the balance, 80,000, right? So there's a mark for you. In here we've got income and expenses. Then we are going to look at, is that the actual figure for sales? No. There were returns inwards of 300. So we're going to have a look here, and you look for this account here, returns inwards, which is sales returns. And we put in there less the sales returns, because our actual net sales after the sales returns is 79,700. So 80,000 minus 300 is 79,700. Remember, with a video you can always pause it at any time and check again. So that's net sales. Now we got opening stock, and we need to go and find the opening stock balance, which is 8,000. Opening stock means the figure at the beginning of the year. So the opening stock at the beginning of the year was 8,000 at the 1st of January 2019. And by the way, while we're here, that first point under additional information, it says the stock was valued at 9,000 closing stock. So we got opening stock and we got closing stock. So now we go back to this income statement, and we put in the opening stock, which is 8,000. I don't really like the layout of this income statement, but I'm sticking to how it's done in the memo. The income statement can actually be shown in a different way, but we'll stick to what you most probably going to get. So the opening stock is 8,000. What we're busy calculating now is the cost of sales, right? The cost of sales. And in order to calculate cost of sales, you need opening stock plus the purchases amount. You add the cost of getting the stock to your premises, which is carriage inwards. Now they go and do a subtotal here. So 43,000, the purchases, I just took that off the opening balances, or the balances that were given to you, and the carriage inwards. Let me just quickly show you. So the purchases, they were 43,000, there it is, plus carriage inwards is 1,600. So the 43,000 plus the 1,600 is equal to 44,600. Then there were, they call it returns outwards. We returned some of the stock that we bought, purchases returns. So that actually decreased the cost of the purchases because the goods were returned. That's why it's in brackets. And it's 44,600 minus the 200 is equal to, they call it net purchases, which is 44,400. So you got opening stock, add purchases, add the carriage inwards, less the purchases returns outwards, gives you net purchases of 44,400. Now the total stock available is your opening stock of 8,000 plus your net purchases, which is 52,400. 52,400. Then what we say is we get the closing stock figure, which is 9,000, which is in the additional information. The closing stock figure is after we do a stock count. There's 9,000 kwacha worth of stock. So now we have the cost of sales. So the cost of sales is equal to 43,400, right? The cost of sales. So it was like this: 52,400, which is the 8,000 opening stock, plus the purchases, net purchases after these calculations were done, is 52,400. 52,400 minus the 9,000 is equal to the cost of sales, which is 43,400. So we calculated cost of sales by doing these calculations, punching in those numbers. So we got net sales minus the cost of sales amount is equal to the gross profit. And on the memo they had scratched this out quite a bit because I think there were errors made. So the amount of the gross profit is 36,300. Sales minus cost of sales. So you see all the information that went into calculating the gross profit. You'll have to practice this. Now what needs to happen to get the total income is you need to add to the gross profit the other income. They call it add gains incomes. Other income. And the other income is discount received is 900. So if we go and have a look, there should be in these balances here, discount received, there it is, 900. Now the next one is, I'm going to do it while we're up here, provision for bad debts. It says here the provision for bad debts is has to be adjusted to 300. Now if I go and have a look here, the provision for bad debts was 400, and provision for bad debts is a decrease in the value of debtors. So provision for bad debts, if it's a decrease in assets, because a debtor is an asset, it will have a credit. Provision for bad debts has a credit balance of 400, right? Now the adjustment says the provision must be made 300. So how am I going to get this account to reflect 300? It's 400. What I need to do is debit provision for bad debts, and I go and credit an income account. I call it, and some textbooks call it, provision for bad debts adjustment, which is an income account, and it gets credited with 100. Because we made this amount from 400 to 300, we are making the provision for bad debts smaller. When we make it smaller, the amount by which we are making it smaller is income, 100, right? So this provision for bad debts adjustment of 100 is other income. There it is. Provision for bad debts provision. I called it bad debts provision adjustment. You can write there decrease. It's 100. So the other income is discount received and bad debts provision. 900 plus 100 is equal to 1,000. So the total income is now the gross profit 36,300 plus the other income of 1,000 is equal to 37,300. So now you've done the income section of the income statement. Now what you need to do is you need to do the expenses section. So salaries and wages amounted to 12,900. And if we go and just have a look here, 12,900, there it is, salaries and wages. Easy, no adjustment there. 12,900, 12,900. Now what they have done here is they've taken out the partner's salary, because that must be shown separately in the current account. Why they took it out was because in the adjustment it says here Chippo is entitled to an annual salary of 6,400 kwacha and Chamba to 3,000 kwacha. Chippo's salary had been paid in full and had been debited to the salaries and wages account. Now what they're doing is that one had been debited to the salaries and wages, the one partner. If it's debited to the salaries and wages, the other one wasn't. So Chippo's was debited to, you need to take it out, okay? Because that salaries and wages is actually relating to your staff. The partners needs to be shown separately, but it was already debited to salaries and wages. So take it out, 6,400. Right, so there's the salaries and wages in the expenses. 12,900 minus the 6,400 is 6,500. So if a partner's salary had already been debited to salaries and wages, we need to actually take that partner's salary out. And the amount, according to the memo that we have in front of us. So the amount for salaries and wages is actually 6,500, which relates to the operations of the partnership. Right, the general expenses was 800. But there was an adjustment of 200. Because remember I mentioned earlier, the general expenses, 200 kwacha was owed for general expenses on the 31st of December. So it hasn't been paid, but we know that we've actually had expenses, general expenses, to another 200 rand. So we truly need to reflect the general expense amount. And at the moment, 800 doesn't truly reflect general expenses because we're trying to calculate the proper profit or loss. So we add that. And we call it an accrued expense, owing expense. So when we did the adjustment, we debited general expenses and we credit an account accrued expenses, which is a liability. You will see in your balance sheet, you might call it something else, but under current liabilities, you can have 200 Rand. But we're only concerned here with income and expenses. Now, there were other expenses, rent and rates. Rent and rates, there was a balance that is given to us at the start of the question, 3,500. But in the additional information, 300 of the 3,500 was prepaid, and it relates to our next financial year. We want to truly reflect the expense for the current year of rent and rates. So we must take out the prepaid amount. And that amount is 3,200. So for rent and rates, the amount is 3,200. Now discount allowed, they gave us that amount. That means a debtor, Discount allowed, yes. If a debtor paid us early, we gave them discount, and to us that is an expense, 1,200. The depreciation was calculated on the straight line method, so we take the historical cost price. You can go check the balance of motor vehicles. It's 30,000. They said the depreciation is at 20% per annum. 30,000 times by 20% is equal to 6,000. Then we've got furniture and fittings. The cost price on our books of furniture and fittings we bought is 12,000. Times by 10% is 1,200. Now if we add up the total expenses after these adjustments, the total expenses are 19,100. There we total it up, 19,100. So what is the net profit? The net profit is your income, total income, 37,300 minus 19,100, and I think that amount there is, you can check, is 18,200. Yes, 18,200. So the net profit of this partnership is 18,200. There's a lot of information in this question, and it is quite tricky, but I don't imagine it will be more difficult than this. So that there is the income statement. Now who's entitled to the profits? The two partners, and they're going to share it. I think 3:2 or 2:3. We can check in a moment. So that's the profit. Then what we're going to do is we're going to go on to the balance sheet. There's the balance sheet, and let me explain quickly a little bit about the balance sheet while we're on a roll. Motor vehicles and furniture and fittings. We start a balance sheet. Assets equals owner's equity plus liabilities. So we're looking at the assets first, right? The fixed assets and the current assets. Motor vehicles, they make this little note here inside the balance sheet. The cost was 30,000. Now if you go and add up your accumulated depreciation, it was 12,000 at the start of the year, but we did an adjustment and we added 6,000. So we want the book value of the assets, the net book value. So we say 30,000 minus 18,000 is 12,000. This is the accumulated depreciation up until the 31st of December 2019. Then we got furniture and fittings, 12,000, and now we have accumulated depreciation for furniture and fittings with the new depreciation amount, which was 1,200. It's now 7,600. That is the cost price for all your fixed assets, also called non-current assets. Fixed assets, non-current assets, minus the accumulated depreciation for all your fixed assets. 42,000 minus 22,400 is equal to 19,600. That is the number at the end of the year, the book value of my fixed assets. Now the current assets, you did a stock count. It says in the additional information. At the end of the financial year, the value of the stock was 9,000 kwacha. The debtors, if you look at the balance in the information given to you, was 6,600. But we need to get the net amount for debtors, which is the debtors amount minus the provision. And the provision, if you go check the additional information, was 300. So 6,600 minus 300 is 6,300. Now, there was a prepayment. I think it was for rates. Yes, for rates. Now, if something is prepaid, an expense is prepaid, then the prepayment amount is treated as an asset. So the prepayment amount is 300. Then there was the petty cash amount, and the petty cash amount is 100. Now what I'm going to have to do is I'm going to stop here at the moment, because I need to go and check those additional informations with regard to the partners. So this is where I'm going to start for the next video. So now I've gone all the way up to petty cash in the balance sheet as at the 31st of December 2019. We looked at the assets, and I need to go and see why current account chipper 1,500 is seen as an asset to this partnership. But I think this is an asset to the partnership, most probably because in this case here, chipper at the end of the financial year, after all the transactions relating to the partner, most probably owes the partnership money. So it's similar to a debtor. That is why it is under current assets, because this partner, after interest on capital, salaries, interest on current account, etc., most probably owes the partnership 1,500. But I'm going to go and check the details with regard to the partners, and we will carry on from there. But you have something here to work with. I'm just going to scroll down so you see the memo. So maybe if you have time, you can have a look at you see there the current account of Chomba is now in the equity section. The capital accounts and the current accounts make up the equity section. So what has happened is this person here, Chipper, it's not appearing underneath here because as a result of partnership transactions, Chipper has actually become an asset to the partnership, because most probably withdrawn too much money. But we will see. I'll elaborate on that in the next video. Okay, chat soon, Elijah. Quite a bit of work there for you to do. It's not an easy question. Okay, cheers.